This is Chapter 8, Video 2. Let's launch. Greetings everybody and welcome back to class. So we're going to go ahead and just kind of launch into the topic, but this video's primary topics are going to be the alternative minimum tax and other taxes that you are going to encounter. It's not supposed to be a whole lot of stuff. We'll kind of just knock it out as much as we can. Now the first thing you're going to notice is that we're going to talk about the alternative minimum tax. The alternative minimum tax, for those of you who did not show up to my class or needed some additional help on this was a tax that was actually enacted because of some news that came out about very rich people not paying taxes, and then of course during the Vietnam War when the Treasury Department did an audit and began to realize that 300 millionaires and billionaires, the top of the top, were paying almost nothing in taxes, and they're kind of like, look, we got a war going on, we need money, and so most important thing in war other than people and bombs is money. I mean, you got to have lots of money, and so that's one reason why it was an intentional situation to continue letting it on going on as it is. But instead of changing and completely overhauling the tax code, which of course was going to be untenable for most people, they just created an alternative minimum tax. And so what happens is you calculate your taxes under one system, you then go ahead and calculate your taxes under a separate system, and you take the higher of the two. And so this is actually going to be the formula. Now, full disclosure, in all the firms that I ever worked with, I have only met one partner that I worked for that fully understood AMT. Okay, most people that I worked for, they kind of like, okay, I know what AMT is, but they couldn't discuss all the stuff that happens in AMT. I had one person that I felt very confident that if I ever had an AMT question, they knew the answer, and if they didn't know the answer, they could get me a short answer very quickly. It generally is one of those things that you don't see a lot of people know a lot about, because it's just kind of like, okay, well, I'll worry about it when it shows up. And that's kind of the attitude I don't want you to take. I'd rather you kind of learn a little bit about this, but I want you to learn the right amount of it. And the reason why, if you were taking my class 3 or 4 years ago, I'd say, look, guys, you got to know this back and front, because a lot of your clients are going to have this problem. You need to understand what the other adjustments are, what the preference items are, blah, 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 so on and so forth. And you need to really be smart about this, because your clients are going to run into this and they need your help in order to figure it out. Well, one of the things is that in the Tax Cuts and Jobs Act, they worked really hard to get rid of AMT completely. With the corporate AMT, they were successful, because corporate taxes only account for about 17-18% of the total gross revenue brought in by the government anyways. Individual taxes, however, different story. And so I guess when they ran the numbers about removing AMT, they began to realize, hey, look, if we get rid of AMT together, we're really going to bankrupt the country. There's just no way that they could do this. And so they went ahead and they kept it, but what they did is they jacked up the rates they jacked up the phase outs, where basically what would end up happening is that you really had to have high income before this is going to kick you where it hurts. And so what ends up happening is the AMT is actually a flatter tax, but being a flatter tax, there's a lot of deductions they don't allow. And so that's what you're going to have with these things called other adjustments, which are preference items. So we'll start off with, you have your regular taxable income, your standard deduction if the taxpayer deducted the standard deduction in computing the regular tax. Here's the thing. If you go under standard deduction, you're going to get the standard deduction in AMT also. Where you're going to run into some problems is that there's certain deductions that are not allowed for AMT. Biggest one that I know of is state and local taxes. If you have a deduction for state and local taxes, they're going to back it out. Now, with the Tax Cuts and Jobs Act modifications that they did, pretty much, the only deduction you get for state and local tax is $10,000 anyways. So that doesn't have as much of an effect as it used to in the past. I remember I worked on a client's tax return once. They had something like a tax bill to DC of like $100,000 because they made a lot of money. And, under AMT, they got none of that deduction. Now, this person also had what was called the P's limitation, which is where they started to phase out your Schedule A deductions if you made too much money. That all went away with the Tax Cuts and Jobs Act. You don't have to worry about that anymore. But because of the elimination of the P's limitation, and then you also have the elimination of most state and local tax deductions, plus the phase out, the increased phase outs as a result of the of the Tax Cuts and Jobs Act, and the increased exemption amount, most of your clients are never going to run into this unless you have really high net worth individuals. And so that's kind of all I'm going to say about that. But you start off with your regular taxable income. It's your standard deduction. Then there's going to be what they call, and they call so that asterisk that's next to that talks about, we call these preference items. We don't just say these are other adjustments. Actually, we normally call these preference items. And so the other preference items that are listed there, what will happen is that there's certain things that are deductible under regular tax that are not deductible under AMT. Now, you could have some positives. And generally speaking, when you're talking about positives, we're talking about temporary differences that have flipped. So for example, if you have something that, good example, you have something that was deductible, it was depreciated over a 200% declining balance, but under AMT it's 150% declining balance. There's going to be an AMT preference item there that once the thing's fully depreciated, under AMT, it may not have fully depreciated yet. So you're still getting depreciation allowances as a result of that. In the end, it's going to be the same thing, but it's got to fully depreciate before it's going to get to that point. And so you could have some certain circumstances where that could happen. You also have your exemption amount if they have any. Right now, I think it's 113 and change for married filing joint. Again, changes every year. That was actually one of the problems they had with the original AMT. They never indexed it to inflation. So originally it was for mostly the top millionaires and billionaires in the world. Ended up really hurting a lot of ordinary Americans that had no intention of being a part of. And so that's actually something that was kind of one of the reasons why they wanted to get rid of this. And then it comes down to your tax base for AMT times your AMT rate. Now the AMT rate, there are two rates. So you're going to have 26% and 28%, and that actually ends up causing a little bit of a bump. And we'll talk. Well, I'll show you a chart that I actually created when doing that. That'll get you to your tentative minimum tax. So you're going to have your tentative minimum tax compared to your regular tax. If your regular tax is higher than your tentative minimum tax, you're going to pay your regular tax. If your tentative minimum tax is higher than your regular tax, then your alternative minimum tax is going to be the difference between that regular tax and the alternative and the tentative minimum tax, and that's going to be your AMT that you're going to have to put on the tax return, because they're trying to elevate your taxes to what that tentative minimum tax is. And so that's going to be how that gets taken care of. Now, like I said, technically the adjustments are referred to as preference items, sometimes referred to as adjustments. We all refer to them as adjustments for simplicity's sake. In this book they do. I've used them as preference items. That's usually what I've called them in my past. So the AMT is based on alternative, more inclusive tax base than regular taxable income, meaning that there's not as many deductions. People with large amounts of capital gains, I would tend to agree with that because there is some aspects of capital gains that do have some effect on that. It's not going to happen too often, though. Like I said, even under the new rules. I mean, I had one person who had like $500,000 of capital gains. She didn't pay any alternative minimum tax. I was actually kind of surprised to see that. Common add-back items. You're going to have tax exempt from private activity bonds. What's a private activity bond? So, if the the county of Fairfax decides they want to build a library, so they go out and they say it's going to be a $10 million library. We need to sell bonds. So they sell bonds. I'm a patriotic citizen, so I decide I'm going to buy $10,000 worth of bonds for them. They sell them at $1,000 a bond. I buy 10 bonds, and then I get an interest rate, and we'll say that the coupon rate is 3%. So every year I'm going to be getting 30, times 10, which I guess would be $300 as my interest. Now, of course, as we talked about in previous classes, that would be tax exempt income. Okay, under regular tax and under AMT. And the reason why for that is because the city borrowed in order to do a city service. That's kind of what that does. Now, sometimes what will happen is the city and states will come back and say, look, we want Amazon to move here. In order to get Amazon to move here, we will build your building, Amazon, if you come and live here, if you come and move your headquarters here. I don't know if that really happened. I mean, wouldn't shock me because that kind of stuff usually does happen. They could build, so they say this is going to be a $30 million building. They're going to go ahead and put out a bunch of bonds in order to build the building. They build, they put out the bonds. I buy the bonds. Under regular tax, it's completely deductible. I mean, not deductible, but exempt. It's totally exempt. Under alternative minimum tax, however, I have to add that interest back because that's actually a preference item because it's a private activity. It's a private activity that the state and local government does. State and local income taxes, again, they're subject to a $10,000 limit. They are going to be added back. So if you got, most people are going to be hit by this. You're going to add just 10 grand back if they're married filing joint or if they're single. And then you have real property taxes, which is under that same $10,000 limit. So it's not a $10,000 limit for each one, but it is something that does get added into that. Okay, so this is the slide. I kind of told you it was going to be an exemption of 113 and change. It's actually 113,400. Again, I don't memorize any of these numbers, but it is something that's useful, at least have an understanding of. Now, when your AMTI, which is your AMT income, income calculator or AMT, is at $1,036,800 or above, that 113,400 is going to start to shrink. Okay, and so what ends up happening is from then until all the way till it gets to $1,490,400. And it says the exemption phases out at 25 cents for each dollar over the threshold. That's a pretty good use of the formula for that. I'll allow you to kind of figure out what that is. Again, guys, for the most part, unless you're dealing with high net worth individuals, you're not going to have to worry about most of this. But I just want to kind of give you just an idea as to what it looks like. And so I actually, just kind of for yucks and giggles, I kind of drew this in the classroom, and actually I realized that I kind of drew it a little differently. So you'll see basically what happens is that I started it off where we have, sort of we're going to have, as we're calculating their income and their taxes, as we're kind of doing it on this. And so you can see basically what happens is that in the beginning, regular tax takes over, and it really takes over until you get to about this level right here, which is about, let's see if I can get that bigger. Yeah, it's going to happen to where you have an adjusted gross income of about $350,000. I'm sorry, $250,000, probably where you're going to start seeing some of that. Now, I want you to understand, this was a scenario that I came up with that they were just, people were married filing joint. They had a maximum, they had state and local taxes equal to 6% up to $10,000. They had a home mortgage that was equal to a percentage of their income, and so basically, as they increase their mortgage deduction increase, because the assumption is if you have more money, you're going to buy a bigger house, you're going to have more mortgage deduction, and then these people were actually giving away about 5% of their income. And if that happens, you're looking at about $250,000, $300,000, where you're going to start seeing this flip. And again, more often than not, I've actually done a lot of clients recently where a good chunk of them didn't actually see the flip till it was around $350,000, $400,000. Again, probably not going to happen unless you've got your really high net worth individuals. But I just kind of wanted to show you, and you see where this big jump happens. That's because of the switch from the 26% to the 28%, and that's where you start seeing that it really starts to take over. Okay. So this was just something that I came up with just to kind of illustrate that. Now, employment taxes, we kind of hit a little bit on this. So if you own a business, actually before that, if you're an employee, you're going to pay 6.2% for Medicare. You're going to pay Social Security rate of 1.45. Additional Medicare of 0.9 if you're over $200,000. If you're single, married filing joint, for $250,000. And again, we all pay this. Everybody pays this. Whether you're an employee or a self-employed individual, you will pay this on self-employed income or wage income, okay? Now, the employer is going to pay an equal amount on the other side. Now, if you're self-employed, guess what happens? IRS doesn't go without. So they're going to take your half, and then they're going to take the business's half. And then, so you're going to have to pay both sides of that when you actually do this. And that's where a lot of self-employed people get a little messed up. They're used to having things withheld from their paycheck when they do their first thing, and then all of a sudden they're like, oh my gosh, I owe all these taxes, because they owe income tax, which could be 25%, and then on top of it they've got the self-employment tax, which is usually at around 15.3%. So that's actually really, really, really big. You want to make sure that you're advising your clients on that. And like I said, self-employed individuals, IRS doesn't go without. Now they will give you a small break on this, where it goes, it's net income multiplied by 92.35%. There is the limit on Social Security. So basically, and I kind of blew over it in the last slide, but if you make more than $137,700, you're not going to get taxed on any more additional Social Security income, and so that's kind of something that's really important to understand. Okay, if net earnings from self-employment is less than $400, there is no self-employment tax. Basically, what the IRS says is that if it's less than $400, we don't want it. It's going to cost us more to process it than it's worth, and that $400, by the way, has been forever. I still remember it back in 2003 when I started doing taxes. It was around $400. So that has been there pretty much for forever. Inflation hasn't changed that number. I wish it would have, but it hasn't. And so, does it apply when both wages and self-employment earnings are in the same year? The answer is yes. The wages will use it first, and then everything above that will be self-employment. So I've had people who are part-time realtors that have had this problem. They're making $150,000 a year at their wage at their regular job, and then on the weekend they sell houses in order to make a little extra dough. And so what happens is that when they fill out their self-employment tax income, they're going to say, look, because your wages has already picked up all $137,700, we're only going to tap you for Medicare wages, which actually can save some people some pain that they wouldn't have had the other way because it's already been withheld, so they don't have to withhold it again. So that's actually a good thing. This is where they're going to be talking about an example due to time. I'm going to go ahead and I'm going to pass on that. And get I do want to talk about this because this is important. Guys, I'm going to tell you, I told you there's a few things in this industry that will make us money, and this is one of them because I have a lot of clients who think that they know how, they say, well, I want to hire people, but I want to hire them as independent contractors. It's not really their choice. It's how, there's certain facts and circumstances, and the primary thing they have is who has control over the work. So, for example, outside my door here, I've got 4 cubes. And if I bring my employees in here and I say, you're going to build tax returns out here and you're going to do these tax returns as I'm telling you, I want you here from 10 o'clock to 6 o'clock every single day building me tax returns, and then from periodically I can make you work overtime to build me tax returns. I own the tax returns. I'm the one who signs everything. Belongs to me. You can tell that there's a lot of control that I have over the employees. Oh, and by the way, you're going to wear the clothes that I tell you to wear because it's a professional environment. I don't want you showing up in spandex shorts and tank tops, which I have actually had an employee did before. Didn't go over very well. But that's kind of the thing. If I have no control over what you wear, if I have no control over what kind of work you do, or if I have no control over how you do your work, then I'm probably not going to have I'm not going to have a problem calling you a self-employed contractor. Now, the differences on this is that if you're an employee, I'm responsible to withhold everything for you. If you're an independent contractor, you're responsible. Now, this cuts as a double-edged sword. Because I've had some times where they're like, look, I want to make them an independent contractor. The other person wants to be an independent contractor because they then get to make deductions or contributions to a SEP IRA, which allows them to go up to $54,000 and change a year, as opposed to doing a regular IRA, which only lets them goes up to $6,000 or $7,000. They want to be able to do this so that they can do that. And I've seen it where the IRS came back and busted somebody where essentially they said, look, you're not an independent contractor, so we're going to go after your employer and get them for failure to withhold wages, withhold taxes and Social Security. We're going to charge them a whole bunch of penalties. And oh, by the way, independent contractor, now we're coming after you for contributing to a SEP IRA. So I've seen where it can actually really hurt people. And I have a client that he and I went back and forth about this, and he swears to God he's an independent contractor. I don't think he is. I've told him I don't think he is. But I've said, look, if you'll sign the statement saying that you've been so duly noted, I'll continue to do your tax return. And he went ahead and he did that, which was actually good because I want to continue doing his tax return otherwise. Because I did give him the advice. I said, look, I'll fill out what the forms tell me to do, but you have to understand, I'm not sure I agree with the treatment of that. And so that's kind of how that works out. All right, guys, so that's all I've got to say about this video. I want to say thank you very much for watching, and I look forward to seeing every one of you guys in class.